2, 1.
Good morning. Today is Tuesday, June 23rd, 2026. This is the Arlington County Board of Equalization hearing. We have 5 board members present for a quorum, and there's 5 cases on the agenda. The first case is RPC 11001061 at 6019 22nd Road North. Mr. Lippman, you can start with your 8 minutes and tell us about this property. But before you start, I don't know who Roy Ralph is, but if you could turn your camera off until your case is called.
Good morning, and thank you to the board.
Hold on a second. I need this gentleman to get off the screen.
Okay, I'll stand by.
Mr. Ralph? Rosa, can you take him down, please? Mr. Ralph, can you hear us?
Yes.
Can you turn your camera off, please, until your case is called?
Okay. I figured that out. I'm not an appellant. I just want to listen to the.
You can listen, but it's distracting to have you moving around on the screen. So I need your camera off.
Okay. There we go. Okay.
There we go. Okay. Rosa, can we reset the timer for Mr. Lippman?
Yes, ma'am.
Okay, go ahead, Mr. Lippman. You can start with your 8 minutes and tell us about the property, sir.
Good morning, and thank you to the board for your time and for the opportunity to be heard. My name is Michael Lippman. I'm representing the owner, Frank Lippman, on 6019 22nd Road North, case 338. One quick correction for the record. The written application referred to the assessment as roughly 2.7 million. The exact 2026 assessment is 2,625,100, the figure I will use throughout today. My point is simple, that the assessment exceeds fair market value and recent comparable sales prove it. Am I able to share my screen? Excellent. Before the comparables, a quick word on how this assessment got here. When the property was first assessed, the August 1st bill came in at 2,253,300. That was when the property was delivered in July of 2025. Then it was updated to 2,462,600, a 9.3% increase. Then for the 2026 assessment, it rose again to 2,625,100. Another 6.6% increase, far above the average neighborhood increase of 3.6%. All told, the assessment was increased about 16.5%, roughly 372,000 in a very short span. I'm here to show the resulting number is above market, and the sales will prove it. The subject home is assessed at 2,625,100. We are asking the board to reduce it to 2,375,000. About a 9.5% reduction. That figure is where comparable sales fall in the neighborhood, as I will show. The county's own standard is 100% of fair market value, what a home would sell for. Their number for the subject property comes from a cost estimate, not a sale. The real test is actual comparable sales, and those are below the assessment in the neighborhood. These are comparable sales bracketing the January 1st, 2026 valuation date, in addition to the 2 submitted that all reflect lower values. The property at 6032 20th Street in December 2024, and 3 spring 2026 sales nearest the January 1st date, 6238 22nd Street, 6243 22nd Road, and 2316 John Marshall Drive. You will note they all cluster at 2.25 to 2.35 million. Every single one below our $2,625,100 assessment. 2316 John Marshall is telling. Openly listed at 2.299 million from September 2025. Across the valuation date, it took 8 months to sell. closing at 2.283 million. Our requested 2.375 million falls within this range. This amount sits just above the 2.25 to 2.35 million cluster, a deliberately conservative request. The comparable sales would support an even lower value. We're not asking for the full reduction. Cost backs this up. Comparable homes actually sold with builder profit included in that range from 2.25 to 2.35 million, below the subject assessment. Our own documented cost to build is right in that range. Value follows the market. Now the county's owned 3 comparables, and 2 of them sold below my assessment, while the third is the single highest sale in the neighborhood. There are no sales before or after anywhere close to that range. The strongest, 6244 23rd Street, sold for 2.635 million, but that is one sale from May of 2025. Every comparable sale has been in that range, 2.25 to 2.35 million. It's the high outlier, not the market. 6032 20th Street sold for 2.296, 923, below the subject assessment, and it is a different construction grade, so it's not even a like-for-like comparison. And 6038 21st Street sold for 1.925 million, the lowest of the new construction sales. If you set the one outlier aside, and the county's own comps land right where the market is, well below the current assessment, subject assessment. To summarize, our request is to reduce 6019 22nd Road North to 2.375 million. The current assessment of 2,625,100 exceeds fair market value as of January 1st, 2026. 2,375,000 is supported by comparable sales and meets the county's own 100% of market standard. Thank you. I'm happy to answer any questions.
Okay, thank you. Ms. Vitus for the county, please.
Hi, good morning. So the subject property is a newly completed 2-story home in the neighborhood of 501023. It was built in 2024 with 5 bedrooms and 6 bathrooms. In July of 2025, the property was inspected for the completion of the construction, at which time the assessment was updated to reflect the home's finished condition. As a result, the improvement value increased from approximately 1.4 million to 1.6 million, and the overall 2025 assessment increased from 2.25 million to 2.46 million. This change reflects the transition from a partially completed improvement to a fully completed home. For the purpose of the 2026 appeal, an interior and exterior inspection of the property was completed on March 20th, 2026 with Nicole Burke to verify the subject's sketch and interior information. For the 2026 assessment cycle, the subject's neighborhood 501023 experienced an average increase of 3.6 and a median increase of 2.7. The county reviewed sales within the neighborhood and identified one new construction sale, 6244 23rd Street North. This property has 5 bedrooms and 5.5 baths and sold in May of 2025 for 2.635 million with a 2026 assessed value of 2.64 million. Similar to the subject, the property was built in 2024, has an effective age of 2024, and a quality of IV-. Both properties contain just over 38,000 square feet of finished living area. The subject's current quality is supported through comparison with comparable and inferior properties. The subject includes features not typically found in an excellent plus property, but commonly associated with IV- construction, including exposed wood beams, high-end appliances, a pot filler over the stove, an oversized kitchen island with a secondary sink and built-in wine fridge, custom cabinetry and built-in storage throughout the home, an exterior fireplace in the outdoor living area, ensuite bathrooms in each second floor bedroom, and a fully equipped laundry room with cabinetry and counter space. These features support the conclusion of the subject's current quality of IV-. Based on the county's analysis of comparable sales, the subject's property, the evidence indicates that the current assessment is supported by recent market activity and is consistent with similarly situated new construction within the neighborhood of 501023. The sales data shows that properties of comparable size, age, and quality are selling in ranges that align with the subject's assessed value. While the appellant does not have a sale that directly reflects the market value of their home, 6244 23rd Street North is a strong comparable. Both properties have similar square footage, year built, effective ages, and quality. The comparable sold around the same time as the subject's completion, and the county considers the sale price to be a reliable indicator of what the subject would most likely have sold for on the open market. Based on the available information, the county recommends affirming the 2026 assessed value of $2.625 million as fair and equitable. I would also like to note that the comparables given by the county both show a direct comparable being that 6244 23rd Street, and the other two comparables, 6032 20th Street and 6038 21st Street, show slightly inferior properties, which do give us a general idea of what smaller and inferior homes would sell for and give us a correlation between what nicer, larger homes are going for as well. Thank you.
Okay, thank you both. Questions from board members? Mr. Pace.
This is for Mr. Littman. The sales comparisons that you provided, can you provide the dates on those again?
Which ones in particular?
You were showing sales dates and numbers. It was a bar graph slide that you had.
Oh, sure. I can pull the screen up if you like. All right. And working from the official record from the county website, the property 2316 John Marshall Drive, that sale was May 15th, 2026, and that was for 2.283. And then 6243 was April 16th, 2026 for $2,350,000. And then the property at 6238 22nd Street sold March 2nd, 2026. And the sale price was $2,249,100. Those are the three new construction in the neighborhood.
Okay. All right. That's all I needed. Thank you.
Thank you.
Take the screen down, please. Okay, other questions? No, okay. Ms. Vitus, if you take a minute to wrap up then.
Yes, thank you. So just to note, I would like to say that the comparables used by the appellant are not within our analysis period for the 2026 assessment, but will be reflected or used during 2027 analysis. I would also like to note that the home is one of the largest, newest, and nicest homes within the neighborhood. That just because a home you paid so much to build for it, it's not necessarily a reflection of what it would go for on the open market, and that's why we use these sales comparables to indicate the current value of it. So again, I would just like to ask the board to confirm our 2026 assessment. Thank you.
Okay, thank you. And Mr. Littman, if you take a minute to wrap up, please.
Gotcha. Just like to thank the board for its time, as evidenced by the new data that is available, as well as the assessments during the study period, including the all new construction sales, indicate that the pricing is lower than the assessment for the current subject, and requesting that the board reduces the amount, and the proposed amount that I'm requesting is $2,375,000. Thank you very much for your time.
Okay, thank you both. Okay, it's just among the board. Where are folks? Mr. Mendez.
Yeah, I feel like we're somewhere between the 2026 assessment and last year's number. Looking at the comps that the appellant provided, several of them were outside of the analysis period. One of them, I think, was, the county said that it wasn't. It sold on December 2nd, 2024, and that was 6032 20th Road. That sold for almost 2.3. The appellant is requesting 2.37. The comp he provided was built in 2020, so I definitely think that the subject property is better than that. So I think we're definitely higher than the appellant's number. But 2.625 feels a little high for me. I know they're kind of leaning heavily on comp one, It looks pretty much the same for the most part, but the lot is much bigger on comp one. So I do think 2.625 is a little high for the subject property.
Okay, and just to point out, the comp that he used, 6032 on 20th Street, is the second comp that the county used.
Oh, I must have missed that.
Yeah, so I mean, so it's sold for 2296 and it's assessed at 2201. So when you look
Okay.
at it, it's got a nice comparison to the subject property. You know, it's slightly smaller.
Right. Okay.
And
Yeah. Yeah. Again, I think it should be higher than 2.3, but I think it's slightly rich for me. I don't know if anyone will agree.
Yeah, I just look at the comps that the appellant used. Unfortunately, they may affect this year's assessment because they're all this year, that they're very far outside of the analysis period. You know, so I am fine with the county's assessment of the, where are other folks? Mr. Yates, or can you turn your microphone on, please?
You know, and looking at the second comp, I'm seeing, you know, less finishes. You know, it is excellent plus, but you know, in a slightly, you know, not that much smaller, but 350 feet roughly, and smaller lot. Just don't in the slightly older, yeah, second sale probably. I'm okay with the county's numbers. I, I, if it adjusts, it's going to adjust next year with these new, with the other additional properties coming in. But I don't have a problem with the county's number.
Mhm. Mr. Penaranda or Mr. Mays?
Yeah, I agree. I mean, it's really a little bit tough because you know the issues that Mr. Mendez mentioned as far as the sale itself. But you know, we have to rely on uh, the fact that the county normally will do these updates as far as the assessment is concerned whenever there's construction and there's an addition and whenever you know the house is finished. It does seem a little bit higher than uh, what is being shown as far as the comparables, but yeah, I agree that most of the comparables that Mr. Lippman brought are just outside the area that you know the dates that we normally would use. So I don't really have too much to go by as far as making an adjustment, and just the fact, you know, just to feel something or come up with a number based on yeah, I feel a little bit high. I don't feel comfortable doing that. And you know, comparable number one, I think it's a good comparable as far as the sale itself, as far as the sales price. So I'm okay with it.
Okay, anything different, Mr. Pace?
Yeah, I was more with Johnny on this. I feel like you know, what we're all kind of saying is obviously the appellant's numbers that he brought indicate that this should be going down. And so therefore I don't think the county's number is correct, but I don't believe we're at the appellant's value yet. When he was speaking, I I felt like the value from 2025 was more in line, which is kind of between the two. But again, that the sales price on comparable one is kind of skewing this a little bit for me. So
Mr.
I'm
Mendez?
kind of,
I just want to make one point. The only reason I think it's a little bit high is just because it's $10,000 lower than the sale of comp. You know, comp one was $10,000 higher, and the lot is 4,000, almost 4,000 square feet bigger. So I don't know what to put it on. I don't know what we could grab onto as far as like what to bring it down by. I think it's higher than last year. I think it's somewhere between 2026 and last year, but I don't think I have the votes to do it. I'm just wanted to make
Uh,
that point.
And I'm in the same page, Johnny. That's what I was trying to get to.
Okay, Mr. Yates?
I think the county's correct, and I'll start there, but the difference is, there's 44,000 more in the land price on the other lot. Land that's just additional land is not the same value as if it were new land that could be developed on. And I think that's the big difference. So it is 44,000 higher. Now, having said that, the only thing I could look at is the difference in the improvement price, and that's roughly 30,000. But I that's picking a number. I think the county's correct, but that's the only for you two. That's the only number I could even try to understand what the differences are. And anyway,
All right. Well, then I'm going to make a motion to confirm the county at 2,625,100. Do I have a second?
I'll second that.
Motion is second by Mr. Penaranda. All in favor?
Aye.
Opposed? Okay, it is 3-2, and that's without Mr. Mendez and Mr. Pace. The county is confirmed at 2,625,100. Thank you both.
Thanks and have a great rest of your year.
Okay, next up we have Ms. Roskin and Mr. Warren. Okay, all right, the next case on the agenda is RPC 1506619 at 2901 Wilson Boulevard. Mr. Warren, you can start with your 8 minutes and tell us about your property.
Thank you very much. I'm going to start on page 30 of 73 of the county's response memo. It's our summary of facts that was submitted. Property is located at 2901 Wilson Boulevard. It's comprised of one tax RPC. Now there is an abutting parking parcel, not under the same ownership that we'll get into a little bit later. But it currently is assessed at $10,845,500 or $662 a square foot. The value we were asking for from the board today is $9,050,000 or $553 a square foot. The property was originally built in 1950. It's a mixed use commercial and retail, ground floor commercial, and then the second floor is small office space. The property is located at the corner of Wilson Boulevard and North Fillmore Street. The commercial office space comprises 8,461 total square feet, and there's 7,912 square feet of leasable retail, which of that is 3 tenants, Ambar, which is a Balkan restaurant, Smoke Source in the middle, and then Mazzaro, which is an Italian restaurant. The main difference between our income analysis and the county's initially was with regard to the cap rate. The county is classifying this as 219 mixed office and commercial, and per their guidelines would apply a 7.15% fully loaded cap rate. So for that office space, we're talking about a cap rate essentially that's applying a base cap rate of 6%. There are no sales or indications of cap rates anywhere near that for small office. Now, the county's own guidelines on that same page at the bottom of page 17 in their commercial, general commercial guidelines indicates a cap rate for small office space less than 30,000 square feet and built with an effective age of 1979 or earlier at 10.3%. And so that's why we're using an 8.65%. It's a blended rate between essentially 50%, which is the retail at 715, and 50% at the 10.3% for small office space, which we think is well supported. That higher cap rate would be supported by the Corpaz cap rate study that Arlington County engaged with that indicated a current average cap rate range of 8 to 13%, with an average rate of 10.3% as of January 1, 2026. So we're talking about, again, this property being assessed at a roughly 300 basis point lower cap rate than what the most recent Core Paths cap rate study would indicate for office in Arlington County as of the January 1 valuation date. Now, also, what we wanted to point out is with regard to this abutting parking parcel, and the county has indicated that in their own comments on page 2. RPC, which is again the parcel immediately adjacent to the subject property, 15066-018, is a parking lot under different ownership. It is under a lease agreement with the subject property to provide parking. The owner charges tenants or gives them an option at $105 per space per month. Now, currently, they're averaging about $1,500 per month in total parking revenue. So not a lot of the tenants are taking them up on that offer. It's roughly $18,000 a year. However, if you look at what was most recently reported in terms of parking revenue, it's close to $255,000 total in calendar year 2025. It's been over $200,000 dating back to 2020, I believe 2023, year end 2023. And that is because, and you can see it on the counties, if you go to the county's page, I believe it's page 4. Yes, page 4, which is their INE summary sheet. You'll see the actual reporting from tax years 2022 through 2025. And in 2022, total parking income reported was 36,500. And then you see it jump significantly after that in 2023, starting at 207,000, 253,906 in 2024, and then 254,764 most recently in 2025. That is because in November of 2022, Parking Mobile was engaged there, and most of that parking revenue that's being generated is from Parking Mobile. It's not from office tenants or retail tenants. It's daily commuters accessing that Parking Mobile and paying those daily rates. So that revenue that's being generated and it is now essentially being valued on the subject property has nothing to do with the real estate. It's that revenue is strictly being generated from the parking lot parcel that is on its own separate valuation. So in our assets, that revenue being included in the income analysis for 2026 is a double count. The county, in their own response as well, I believe that's on page 3, lists the lease. They consider it like a debt service and not an allowable operational expense to be considered. Well, we would think the same thing about the revenue that's being generated from that adjacent parking parcel. Again, a very small amount of that parking revenue is being generated from the charges or the optional, the option for the tenants to purchase those monthly spaces. And if we were to just take that average, if we were to adjust the county's current income model, which is including which is estimating 253,900 in total parking revenue in their income analysis, and drop it down to what the average is for what those tenants are paying annually, which is 18,000, would indicate a significantly lower value. It would drop the value down from 10.8 million to 7,546,252. So those are the two things we'd really like the board to consider. Is one, the cap rate, which again, half of this property is small office space, which is being applied at a 6% base capitalization rate, and the other being the income that's being reported or used in the current analysis for the 2026 assessment with regard to parking. Thank you.
Okay, thank you. Ms. Roskin for the county, please.
Good morning, board. Good morning, Blake. So with this particular property, we're looking at columns E1 and E2. Okay, E1 is what the owner reported for the 2025 INE. That includes the parking revenue and it includes the parking expense. And then there's the column 2 with the reconstruction where we removed the parking expense and you can see what the NOI resulted in. But I want to bring you back to the January 1 assessment. So when you take a look at, first of all, at our January 1 assessment, and you look at the revenue that we used, our revenue for the office is less than what's being reported for column E1, which is the 2025 INE. And you look at the retail, our January 1 assessment, that revenue used is less than what's being reported. And then you jump down to the pass-through, that is less than what's being reported. And yes, so when I looked at this, I did not do a test. I go because I was looking at, all right, how does our EGI look in comparison to what they're being reported? I go, well, our EGI is slightly less. It's only by a couple of thousand, but it's slightly less. And then when you go down to the expenses, we did include the expense for the parking. Okay, so yes, we're including the revenue, and yes, we are including the expenses in the January 1 assessment. And you go down a little further and you look at the NOI. So the January 1 NOI is less than what's being reported in column E1, which is the 2025 INE reporting. As for the cap rate, we actually have a separate cap rate for this particular property class, the 219, which is a mix of office and commercial. There were sales this last year, and their cap rates were around 5.2 and 4.2. When you add in the tax rate, that brings you at a brings you in at a 6.35 and a 5.35 loaded cap rates. And as you can see, the cap rate that we're using is substantially higher than that. And as for the neighboring property, it's not being assessed on the income approach for that parking. So we're just this owner is reporting the revenue and expenses for that parking space, and we believe that it belongs here with this particular property. I'm going to leave my mic open for Irving if he wishes to add any additional comments.
Good morning, board. I think it's important to note what Lori pointed out, that parking lot is valued basically for the land only. There's some cost value to it based on the paving, but we do not value this property on the income approach, so there's no double counting of the income. That could be something that we consider in the future. But if you look at the summary sheet that Lori provided, the pro forma from the appellant includes that parking income. The pro forma from that appellant includes the parking expenses. And the pro forma for the appellant is higher than what the original assessment was. The main difference in this case is the cap rate. And as Lori stated, we have a cap rate for this PCC, which is 715. So there's no reason to take a blended approach. We do the blended approach mainly on apartments, as the board is aware, and that's because of the different tax rates. But we have a cap rate for PCC 219, which is applied in the original assessment. And I think, as Lori said, the assessment should be confirmed based on the information that's provided. Thank you.
Okay, thank you. Questions from board members? Mr. Mendez.
Yeah, for the county, if this were just strictly general commercial with no office, what would the cap rate be?
Strictly 7.
Just be 7, so
7.0.
there's a 0.15% increase?
Yes.
Okay, thank you.
Mr. Pace?
Yeah, this is for Mr. Warren. So the current or the 2025 value was 9,912,800, and you're basically indicating that the value of the building is going down. And we spoke briefly about the parking expense and the cap rate. Is there anything other than those two factors that would indicate that the value of this property should be going down?
The two main things is, again, yes, and you can look at the historical parking income, and that has it has a direct correlation to what the how this was being valued as well before Park Mobile came into the picture, and that daily parking increase in revenue really increased in terms of their annual parking revenue. But again, that revenue is being generated specifically from that adjacent parcel that's on its own tax parcel and has its own valuation. So we don't feel it's appropriate to then pull that income in to that really has nothing to do to anything with regard to the real estate of the subject parcel and place value on it, like you capitalizing the income
Okay.
from that parking revenue.
Okay, Mr. Yates?
Blake, there is this property maintaining that parking area? There's an expense in there. I mean, are they shoveling? Are they paving, lining, potholes?
They are doing some annual, it appears, maintenance, or they're reporting some of this annual maintenance and expense. I think it was a couple $1,000s most recently. The lease charge, I believe, was 57,000, and there was like another additional 2,800, $3,000 in repairs and maintenance.
So the owner of that property really isn't doing any of that maintenance. It's up to the owners of this property.
Yeah, I wouldn't be able to speak on behalf of exactly
Okay.
what they've done.
Okay.
Okay, other questions? Okay, Ms. Ruskin, if you take a minute to wrap up then.
Okay, so once again, the owner is reporting this parking revenue and the expenses in their income and expense statement. And we've done the same for the January 1 assessment. And when you compare the office and retail revenue year over year, it is increasing year over year. It has not gone down. The other property, the neighboring property, we do not value that on the income approach. It's not, they don't submit any income and expense statements, and we're not valuing them on the income approach. They're just strictly, it's the base land. This particular owner is basically maintaining that property for the purpose of his property. And we believe that our cap rate is well supported. We have we have sales for this particular property class. We do not mix cap rates. We are asking, and our NOI is less than what's being reported for the 2025 INE. We ask that you confirm the January 1 assessment of $10,845,600. Thank you.
Okay, thank you. Mr. Warren, if you take a minute to wrap up then.
Yep. And so look, the county's correct. They are reporting that revenue for the parking and the expenses, because there is a lease in place to give their tenants, their office tenants, the option for that parking. Again, it's only generating, at least for their tenants in the office building, around $1,500 a month, $18,000 annually. The majority of that parking is coming from daily users of Park Mobile. So again, the majority of that revenue, regardless if the county is valuing this separate parking lot parcel on the income approach or not, it still has a value. They place a value of fair market value on it. And now that this additional income that's being generated from that parcel is now being assigned and capitalized in valuation on the subject property. But again, that subject property, it only contributes a very small portion of the actual parking revenue. So we think that to capitalize it in the valuation of the properties is inappropriate. Thank you.
Excuse me. Okay, thank you both. All right, it's just among the board. interesting information to get so late in the game here. What does everybody think? Mr. Yates?
I'm fine with the county. You know, they're not being charged. It's not a value of being placed on the land of that parking area. And I think that's part of this discussion. The revenue has gone up. The county is lower than the 25. I see no reason that this should be adjusted.
Okay. Mr. Pace?
I would agree with the county's NOI. I think the only discussion that was worth hanging the hat on would have been the cap rate. I didn't really see a compelling argument for that. So for me, I'm okay with the county's increase, or the county's number.
Great. Anything different, Mr. Mendez or Mr. Veneranda?
No, I agree with everything. I think every number shows that the county is correct on the assessment. I'm okay with it.
Okay. Anything different, Mr. Mendez?
Nope, looks good to me.
Okay. Would somebody like to make a motion?
Sure, I'll go ahead and move that we confirm the assessment at 10,845,500.
Okay, we've got a
I'll
motion, a second, Mr. Gates.
Second.
Motion and a second on the table. All in favor?
Aye.
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 Opposed? There are none. Okay, it's unanimous. The county is confirmed at the 10,845,500. Thank you both.
Thank you all. Thank you, Lori.
My pleasure. Just doing my
Okay.
job.
We're keeping Ms. Roskin, and then do we have Mr. Price? Saw him earlier. There we go. Okay, the
Yes,
next
ma'am.
case on the agenda is RPC 35005002 at 815 18th Street South. Mr. Price, you can start with your 8 minutes and tell us about this property.
Yes, ma'am. Good morning, board, and thank you for the opportunity to present my argument this morning. The subject of this appeal is Parkview Apartments, and I'll start on the BOE's memo page of page 40 with my summary of facts. As I mentioned, this property, the subject property of this appeal is Parkview Apartments. The property address is 815 18th Street South. The current assessment, 2026 assessment, is $29,520,000, and my requested value is $27,506,500. This apartment building is a mid-rise apartment building with 82 units, originally built in 1962, but it has an effective age year of 1977. And just wanted to start on page 41 with our main issues. Our analysis is based on aligning the evaluation with the actual property performance and the county's own guidelines. Our analysis incorporates the calendar year 2025 I&E data, which reflects the most accurate representation of current operations. While we maintain the county's assumption for revenue and vacancy, the actual operating expenses totaled $857,900. Which is materially higher than the $740,109 used by the county. Using lower expenses understates the true cost of operating the property and inflates the net operating income. Secondly, we wanted to highlight the Arlington guidelines for the 2026 commercial guidebook. The county applies a $9,026 per unit, which is below the stated minimum for a building that has an effective age year of 1977, which is $10,657 per unit. In our analysis, we are requesting an expense level of $10,462 per unit, which once again we believe is supported by both the actual operations and also the county's published guidelines. And then finally, the actual calendar year 2025 NOI is $1,697,644, which is below the $1,726,922 used in the county's model. This further demonstrates the county's valuation overstates the property's income producing ability. Together, these factors show that the county's model understates expenses and overstates the NOI. So we respectfully request that the board consider actual operations at the property, as well as the county's own guidelines for expenses. We do appreciate the county taking a second look at our analysis, but looking at their revised analysis, they did make some adjustments in their income model that we further do not agree with. Overall, they did increase their NOI from 1,726,000 to 1,793,000. They did this with an increase to the income, and also an increase to the expenses. Their expenses increased from 740,000 to 815,000, still just about $100,000 short of the actual expenses at the property. So looking at page 4 of the BOE memo and page 14, one of the primary issues is relates to the treatment of the recurring replacement costs. The county has excluded several expense line items on the basis that they are capital improvements. However, based on the property's actual operations, these costs are reoccurring in nature and function as ongoing maintenance rather than the long-term capital investments or improvements at the property. Specifically, items such as the appliance replacements, including dishwashers, ranges, refrigerators, and washers and dryers. These units occur regularly. Replacements and maintenance for these units occur regularly due to the normal wear and tear of the tenant. These costs are incurred annually, as previously mentioned, to maintain unit functionality and marketability. In addition, there was some flooring, furniture, and fixture replacements that are also reoccurring expenses that are necessary to keep the units in rentable conditions. Once again, these are not one-time capital improvements that extend the life of the building or even the specific unit. Instead, these represent routine operating costs, which once again sustains occupancy and preserves the rental income. So we believe that when the county chooses to exclude these reoccurring expenses, the county understates the true operating cost structure of the property and overstates the NOI. So just finally, we would like the board to consider the actual expenses at the property, and make an adjustment to the income model accordingly. Thank you.
Okay, thank you. Ms. Roskin for the county, please.
Okay, thank you. So for this particular analysis, I used a test column. It's not a revision. I put in a test column, and the reason why I did that, I took a look at our January 1, and I looked at what they reported for 2025. And what happened was I was going, okay, maybe we should test this because they're reporting a little bit higher vacancy rate, and they're reporting a little bit higher expenses than what we used for the original January 1. So that leads me to analyzing the rent roll, and you can find the rent roll, I believe it's on page 5, and I'm sorry, pages 6 and 7. Yes, pages 6 and 7. So upon analyzing the rent roll, I took those numbers and I plugged in. I actually used a less than what was being shown in the rent roll analysis. For each one of those, the efficiencies, the 1 bedrooms and the 2 bedrooms, I used a rental rate that was less than what I found in the 2025 rent roll. And keep in mind, the rent roll is historical, and we're projecting our value for January 1. So that's what I did is I tested that out using a less than number, and then using our 4% vacancy rate. When we get down to the expenses for the maintenance and repair, I excluded, and I did ask this in the email, which is attached to this case. I did ask, please explain what's going on with your higher than typical maintenance and repair. And they did state that they replaced a number of items, appliances, furniture, fixture, carpet, and tile. And when you're replacing these things, we consider these a capital improvement. They did also report an additional 63,600 in maintenance of other appliances, if they have to repair some appliances, repair carpets or floors or things like that. That's general maintenance that occurs every year. We did include that. That is included in the reconstructed column. I just removed the 42,000 for the capital improvements. And those capital improvements are captured in the cap rate because they're considered a risk. This is something that the investor assumes. It's a risk, and it also affects the effective age, which, these all things are considered in the cap rate. So that's why I exclude the 42,000. For the little double asterisk as the expense for the sub admin expense, I didn't take anything out there. Okay, if you'll note, it's the same. All I was doing was trying to point out why that had a significant jump from year over year, and it was because they're using a paid search remarketing, and I showed you there how much it jumped considerably. It almost like tripled from 2022, and from 2024, it was about, I don't know, 30, somewhere in the ballpark of 33% higher than the year before. All I was doing is just pointing that out, why that increased. It was left in. So, in the test column, I looked at the expenses and I go, okay, the expenses are more in line with what was being reconstructed. And so that's what was used. And when you look at when you compare the NOI, it tested out higher. So going back to the January 1 assessment, when you look at our final NOI, and it's little less, it actually falls in between the two, which have a very narrow, the 2025 and the reconstruction has a very narrow NOI. Our January 1 falls right in between those two. I'm open for questions. Thank you.
Okay, thank you. Questions from board members? Mr. Pace.
This is for Mr. Price. What are you not, so when you look at your 25 number to your pro forma, you have the performance of the building on income basis going down. I can't remember, did you specify why you believe that your income will go down over this next year?
So we are using the for our income, we are in our income model, we are using the income that the county has provided just to be consistent with how they're viewing the property. The actual income at the property for calendar year 2025 was 2,351,000. So we do understand that there is, a slight difference between what the actual income was versus what the county has for income. We were just really focusing on the expense aspect of it. So, I would imagine the property owners would love for the income to continue to trend upwards. But in terms of looking at our argument for this morning, it's strictly based on the expenses.
Okay, thank you.
Okay, other questions? No? Okay, Ms. Ruskin, if you take a minute then to wrap up.
Sure. Okay, so once again, you can see that the income for the apartment is trending up. I don't see it going down. When I reviewed the rent roll, and I tested it. I actually used a test number less than what is being supported in the rent roll analysis. Looking at the expenses, like I said, the only expenses that I excluded are capital improvements. We do not consider those as a typical operational expense. That maintenance is already being accounted for in their income and expense statement. And so when I did the test column and I looked at the expenses and then looking at our January 1 assessment, we feel that our January 1, our NOI is supported, and we feel like the January 1 value is well supported at 29,520,000. Thank you.
Okay, thank you. And Mr. Price, if you take a minute then to wrap up, please.
Yeah, so the biggest difference is going to be the expenses in our analysis. The county is not using the 2026 guidelines that they're supposed to follow. As I mentioned, with the building of this effective age, the guidelines state that the expenses need to be $10,657, which is in line with what the calendar year 2025 actual expenses were. And then I know that the county has repeated that, they're taking away capital expenditures, but that's not true. They're taking away reoccurring expenses of furniture, fixtures, and also some in-unit replacements. If you look on our page 15 of the BOE memo, you'll see that in our provided internal statements, there is a difference between capitalized expenditures and the expenditures that they're choosing to remove. So we would just like those to be considered, especially the county guidelines. Thank you.
Okay, thank you both. All right, it's just among the board. Where are folks on this? Mr. Mendez.
Yeah, I ran some tests with the expenses and I tried to move things around here and there, but ultimately I'm okay with the assessment. Just looking in column D, the GPI is less or more than less than $100,000 than what was actually achieved. And you look at the difference between the expenses that they're using and that the counties use, and it's less than that. So all things considered, I think I'm okay with the county's assessment.
I agree. Anybody else?
I agree.
Mr. Pace?
So I actually, listening to both of them, I slightly disagreed on both sides. I felt like the appellant was wrong and not addressing the income that they're going to get, but I also felt like the county was underestimating how expensive these properties are to run. So I felt like both sides were true. It gave me an NOI, and once you kind of adjust the cap rate, it ends up becoming a number close to where the county was, not significant enough to lower it. So I think the county did a good job. I just will point out that these buildings are significantly more expensive to run than the county gives them credit for. With that being said, I would, and the county's number is only a 4% increase on which would track with the income. So I'm okay with the county's number.
Okay. Anything different, Mr. Penaranda?
No, I'm okay with it. I agree with everything.
Okay. Somebody like to make a motion? Okay, Mr.
Sure, I'll
Mendez?
move that we confirm the county's 2026 assessment at 29,520,000 even.
Okay, motion, and I'll second. All in favor?
Aye.
Aye. Opposed? There are none. Okay, it is unanimous. The county's assessment of 29,520,000 had been confirmed. Thank you, Ms. Roskin. Okay, next we have Ms. Shuttlesworth. Okay, the next case on the agenda is Economic Unit 1601803A at 1500 Key Boulevard. Mr. Price, you can start with your 8 minutes on this property, please.
Yes, ma'am. The subject of this appeal is 1800 Oak Apartments, located at 1800 North Oak Street. This is a mixed unit, a mixed development property with 314 apartment units and just over 3,300 square feet of commercial space. This is a property that was built in 2003, and it consists of three separate parcels. The parcel that we are requesting an adjustment to is in our package on page 7. At the bottom, it outlines that we are only requesting an adjustment to RPC ending in 001. So starting off with my analysis, we do agree that the income approach is appropriate for valuing this apartment building, but we believe that the county is overstating the property's operating expenses and as a result overstating the value. Starting off with the gross potential rent, in our analysis, it reflects the stabilized operations based on the calendar year 2025 performance. The gross potential rent is supported by the actual calendar year 2025 results, including $10,735,991 in apartment income, along with $378,094 in parking income and $483,525 in other income. And we have applied the county's 5% vacancy rate to maintain consistency. For the expenses, the subject property is over 20 years old and experiences higher operating costs than newer assets. The actual calendar year 2025 expenses total at $3,282,237, or $10,453 per unit. In contrast, the county is applying an expense per unit of $8,998, which is below actual performance and below the county's own guidelines of $9,194 per unit for comparable properties. By understating the expenses at the property, the county's model inflates the NOI and results in an overstated value. So we request that the board consider not only the county's guidelines for expenses, but also the actual expenses at the property. Moving on to the cap rate. Another key issue in our appeal is the cap rate. The county's capitalized rates are not aligned with current market conditions. In today's higher interest rate environment, cap rates remain elevated as increased borrowing costs require higher returns and place downward pressure on values. Despite this, the county reduced cap rates from tax year 2025 to tax year 2026, which is now supported once again by the market evidence. Both local and national data indicate the cap rates have remained stable or increased. Recent CoStar data across Arlington submarkets reflects an average base cap rate of approximately 5.5%, and national sources such as RARC, PwC, and Newmark reports averages near 5.96%. And you'll see that in our analysis, those data sources on page 5. Based on consistent local and national evidence, the county's cap rate understates the market risk and overstates value. We respectfully request the board to adopt the base cap rate of 5.5%, which better reflects the current market conditions. And once again, you'll see our requested cap rate versus Arlington's cap rate on page 6. Arlington County is using a base cap rate of 4.3% with a loaded cap rate of 5.59%, and we are requesting the base cap rate of 5.5% and a loaded cap rate of 6.7%. Now moving on to the commercial space. The commercial space, we are using the gross potential income that's supported by the December 31st, 2025 rent roll, which reflects a total income of $128,849. For consistency, again, we are using the county's guidelines of 7% and 7% vacancy and a 7.078% cap rate. But we do differ in expenses. The Arlington County's tax year 2026 guidelines indicate an expense ratio of 15%. The county is only applying a 14% cap rate. A 14% of expense ratio. We have applied the full 15% expense ratio in our analysis. While this variance is modest, it does understate the operating expenses. So we would also once again request the board to apply the published guideline of 15% for the expenses for the commercial space. And then finally, as I mentioned at the beginning, on page 7. On page 7 at the bottom, we do have the value allocation where we're only requesting an adjustment to the RPC lot ending in 001. So with the aforementioned adjustments, specifically being on the expenses for the commercial and the apartment portions, we're requesting a value of $149,209,200.
Okay, thank you. Ms. Shuttlesworth for the county, please.
Yes, good morning, board. Good morning, Mr. Price. So this is a high-rise apartment building with 314 residential units, out of which 34 are committed affordable. The property also includes about 3,800 square feet of retail. This property was inspected in June 2024. During last year's BOE review, the 2022 and 2023 INEs were reconstructed to remove 1.7 million worth of replacement reserves, casualty losses, and capital expenses. As the board can see, the 2023 was also reconstructed to exclude 1.3 million worth of capital expenses, casualty losses, and construction costs. When we look at the historical trend at this property, we can see that the apartment potential rent has been increasing for the past 3 years. We can also see that the same positive trend was noted in GPI and EGI. The retail income has been pretty much steady between 2022 and 2024. We can see a slight uptick in commercial rent, about 4% in 2025. Also, the retail rent roll analysis are included in page 19 of the BOE packet. The vacant unit has a new lease in place, which will start in August this year. And as the board can see, our tested retail is very close to the figure reported in the past 4 years, and it's also pretty close to the figure projected by the appellants. The 2025 INE survey submitted shows a decline in the NOI, and I would like to emphasize that this is due to an elevated maintenance and repairs costs that were reported. The appellants are reporting an over 54% increase in maintenance and repairs in 2025. So we have reached out to the appellants regarding these expenses. We received the feedback. The board can see the page 18 in our BOE packet. There's an email communication included between the department and the appellants. They did provide the breakdown of those repair and maintenance costs. However, there were 2 line items that still stood out. Particularly, there was building repairs and maintenance in the amount of $156,674, and also common area repairs of $80,937. So I did follow up on those 2 particular items because they do add up to over $240,000. And my follow-up email is included in page 17 of the BOE packet. And unfortunately, we did not receive further breakdown of those expenses. And looking at the appellant's pro forma, they are projecting 2.9% decrease in GPI, while the property experienced growth in the past 3 years. The rent increased by 4.28% in 2025 and over 6% in years 2024 and 2023. And we see the same pattern with EGI. They are projecting 3.7% decrease in their pro forma, while the property showed year-over-year increases. And the cap rates, we use the third quarter of commercial real estate investment publications. The fourth quarter was not available to us at the time of the valuation. And the list of publications we used, it's included in BOE packet on page 20. And with that, I'm open for questions. Thank you.
Okay, thank you both. Questions from board members? None? Okay, Mr. Mendez.
Yeah, to the county. Do you mind breaking down a little bit more about the expenses that were removed?
So, yeah, so these expenses were removed on prior year's review. I know I reached out, well, I did reopen the case from the last year, and I just noted that 1.7 million worth of replacement reserves, casualty losses, and capital expenses were included. I don't have the exact breakdown of those expenses. I can reach out to the appraiser who did perform this review last year. But I don't have the line by line item breakdown in front of me right now.
Okay, thank you.
Okay, Mr. Pace?
To Mr. Price, you at the end of your presentation, you gave the total value that you're looking to change. What was that total number again?
Yes, sir, and I misspoke. I stated the proposed assessment for this for tax year 2026 when I should have said our requested value is $116,439,200.
I just wanted to clarify. Thank you.
Okay, no other questions? All right, Ms. Shuttlesworth, if you take a minute to wrap up then?
Sure. So our test column F3 represents all components: committed affordable market units and retail. We projected a modest 1.53 increase in our GPI based on the historical data presented. The property has been experiencing a year-over-year increases in GPI ranging from 4.2% to 6.95%. So we believe we were very modest. The appellants also projected a 2.9% decrease in GPI. We did not see the declining trend in the past 3 years. We tested less than 1% increase in EGI. Also in our column F3, the property's EGI has been growing year over year from 3.9% to 6.5%. The appellants are projecting a 3.7% decline. The 2025 INE indicates a decline due to an elevated maintenance and repairs costs. If I was to exclude that $240,000 worth of unexplained expenses, the 2025 NOI would result in year-over-year increase over 2%. Thank you.
Okay. All right, thank you. And Mr. Price, if you take a minute then to wrap up, please.
Yes, just to reiterate, we did provide more information about the expenses, but I believe that the county has continually taken away expenses that they deem capital improvements, but they are indeed not capital improvements. As the age and years go on to operate these properties, the expenses do increase, and we have in full faith and confidence filled out the INE every single year, and the county comes back with questions, and we do our best to answer them. But it does get to a point where there's no further explanation that we have for expenses. In order to operate the property, it comes with high expenses at the property. So we would just like the board to consider that, and also consider the guidelines that the county is supposed to be held to. So thank you.
Okay, thank you both. Okay, it's just among the board. For folks. Mr. Penaranda?
Yeah, same as the previous case. It's hard for me to consider just one piece of the argument that the expenses are not considered, but ignore the income. We're okay with that. It's lower, but yeah, I'm okay with the current assessment the way it is. I think all the numbers again show that NOI, EGI are in line. So I have no numbers to make any change to it.
Okay. Anyone else? Mr. Mendez?
Yeah, I thought the expenses looked a little bit low. Again, they were lower on the GPI as opposed to what was achieved. So I tried to keep that in mind. I did run a little bit of a test where in column D, I bumped the expenses up to 3 million. And that sort of equals out with the lower GPI and column E and how all that works out. And it was a slight reduction to 146,087,300. So I think the expenses are low. I would be in favor of dropping them a little bit if anyone agrees.
I was actually going to say my number was closer to 145, but I think Johnny's onto a good point here. I would support Johnny.
How'd you get the 145, Mr. Pace?
I don't know. I was making adjustments and I got there and I can't remember how I did the work. So that's why I would be more comfortable with your number.
Right, I guess I see where you're going with it, and I think, again, without having the 2025 information, they did a fairly decent job when you look at the actual history of the property, but in the test, they did increase it to 3.15, almost 156. So that's where I'm kind of struggling.
Well, they also increased the income a good amount as well over, I'm just comparing everything to column E.
Right.
It just looks a lot higher than column E to me, so that's why I wasn't so focused on the test. And the reason why I'm a little more willing to increase the expenses on this case as opposed to last case was just because it wasn't as clear cut and dry what was taken out. Last case, I mean, it was all right there. Couldn't argue with it, but it was a little bit less clear on this case for me.
Mhm. Okay, Mr. Yates, where are you?
I'm fine with the county. I'm looking at the offset of the income compared to 2025 and with the expenses, and it's close. I think the county did everything they could to do this right, and I don't see the property going down.
Yeah, I think that the test confirms the original assessment. Again, having the information, so I'm fine with it.
You know, I do see the appellant takes the income the county used in their assessment, but then they apply their own expenses. And I don't think that's quite fair. They'll use the 25 expenses, but not the 25 income. I don't buy that.
Yeah, no, I agree. Okay, somebody want to make a motion then?
I'll go ahead and move that we confirm the assessment at 149,209,200.
Okay, we have a motion. I'll second. All in favor? Aye. Opposed? Okay, it's 3-2 without Mr. Mendez and Mr. Pace. The county is confirmed at 149,209,200. Thank you both.
Thank you.
And the last case is still Mr. Price, and we have Mr. Bynes. There we go. Okay, the last case is RPC 180380025 at 2201 North Pershing Drive. Mr. Price, you can start with your 8 minutes on this property.
Yes, ma'am. Good morning again, board. The subject of this appeal is 2201 Pershing. This is an apartment building on 2201 North Pershing Drive. Starting off with my summary of facts, the tax year 2026 assessment value for this property is $108,123,300. My requested value for this property is $89,499,700. This property was constructed in 2012 with 188 apartment units and just over 33,400 square feet of commercial space. Starting off with the gross potential rent in my income model. Once again, we have used an income approach similar to the county, but looking at the gross potential rent, this is based off of the rent roll as of January 1st, 2026, which reflects $6,190,238 in apartment income, along with $328,350 in parking income, and $523,534 in other income. These figures once again represent the actual income at the property for calendar year 2025. We are using the county's 4% vacancy rate as seen in their pertinent data, as seen in their guidelines. But we are requesting an adjustment to the expenses. The calendar year 2025 expenses amounted in $2,003,141. Taking out the commercial expense applied, which in our income model is $193,387, develops an apartment expense of $1,809,754, or $9,626 per unit, which is above the county's guidelines of $9,466 per unit, while the county's expense per unit is $8,833 per unit. Once again, this is a property that is year over year. The expenses have increased as operating a property of this size and with this age continues to increase year over year. We are also requesting a adjustment to the cap rate. We have supplied similar cap rate studies and publications of CoStar for the Arlington submarket, also the fourth quarter RERC and PwC reports, all highlighting that there has been either cap rates have stayed the same or actually increased, while the county year over year has decreased their cap rates. So you'll see on our page 6 of our analysis where we compare the Arlington base cap rate of 4.4%, and we are requesting a base cap rate of 5.5%. Moving on to the commercial component, the department is overstating the commercial gross potential rent by applying a $45.50 a square foot, or $1,399,813. We are relying on the actual calendar year 2025 performance of the property, which reflects $1,085,490, or $35.28 a square foot, along with recoveries of $300,795 in our analysis. Once again, this figure comes from the rent roll, which more accurately reflects what occurred in calendar year 2025. We are using the county's guidelines for retail and commercial properties for 7% vacancy and also 7% for the capitalization rate. But we are requesting an adjustment for the expenses. The county's tax year 2026 commercial guidelines indicate an expense ratio of 15%. The county is only using 12%. So we are requesting that for the commercial portion that the board please consider the 15% expense ratio seen in their guidelines. So at this time, we are just requesting the main area is an adjustment to the expenses for the residential and the commercial space. Also for the commercial space, a reduction in the gross income, seeing that the actual income at the property for the commercial space is quite lower than what Arlington County has in their income model, and also a cap rate adjustment due to the fact that from our research looking at RERC, CoStar, and PwC, we are seeing that cap rates are decreasing or staying the same, and not we've seen the cap rates increase or stay the same, not decrease as Arlington County has in their income model. So with all that being said, in our analysis, our adjustments in our income model result in an adjustment and a value of $89,499,700.
Okay, thank you both. Questions from board members? Oh, I'm sorry. Mr. Bynes for the county, please.
Okay, thank you. Good morning, board. Good morning, Mr. Price. First of all, I'd just like to note a slight correction for a mathematical error on page 4 for the summary sheet on column D2. For the totals of the GPI, it should be $8,573,833, and for the GPI, it should be $8,213,472. The rest of the numbers for the expenses and NOI are correct, and the final valuation are correct. It does not change the overall story for the overall evaluation for 2026. I will start by saying, yes, this is a 188 unit mid-rise mixed-use apartment with 170 market rate units and 18 committed affordable units. I would like to start on page 4, comparing columns D1 through D3. This is our assessment. To column E, this is the 2025 actuals that were provided on the I&E. If we take a look at the apartment income versus the reported income, we can see that our total was 0.61% higher than what the actuals were. If we go take a look at the GPI, we can see that it turned out to be 0.43% lower than the actuals. And for the EGI, it turned out to be 1.34% lower than the actuals that were for 2025. Our expenses that were projected were lower than what happened at the apartments in 2025, which resulted in an NOI that was 1.22% higher than the actuals that happened at the apartments in 2025. I did take this information and created a test columns, go through F1 through F5. As you can see, take you back to column E. When we compare those year over year, we can see that the apartment income was 3.94% higher than 2024, which is in column C. The EGI was 5.19% higher than in column C. Also, the EGI was 5.33% higher than in column C from previous year. Also, the NOI was 2% higher. I did create a test. I did based on the 2025 data that we got from the appellant, which if we go over to column F2, we see the total apartments was slightly, I used conservative numbers, which resulted in a 2.31% raise in the apartment income. Also, if we go over to column F4, we can see that there was a 2.39% increase overall. Also, for the commercial portion, this commercial portion is 100% occupied. If we would go to, if we go to page 8 of the BOE packet, this is the commercial rent roll with all the information that was provided through by the appellant. Again, this is 100% rented out space. It is a very strong leases with the most recent lease set to end at mid-2027. With the annualized rate, we use a standard 3% increase for the rental rate, which is standard, which resulted in the numbers in column F5 for the retail when adjusted. And we can see that was significantly lower than what we had for our 2026 assessment. We also, for the expenses, we use the same expense rate of 24.1 that was seen in the property of 2025, which resulted in slightly higher expenses. This is even higher than what the appellant used in his pro forma. When that came out to a new NOI that is 1.41% higher than what was achieved at the property, which in the end you can see in the test column, we can see that resulted in a higher valuation at the property, or sorry, higher test than what we had for 2026. With that said, also the cap rates, we develop our cap rates from sales information that happened within the county, recent sales. If you our sales information is included in the commercial guidebook. And when you look at the apartment sales, you can see that our evaluations are right in line with the evaluations for the actual sales that have taken place. So we feel our cap rates are strongly supported, even in the with third-party evaluations such as RERC and PwC. With that, I am open for questions. Thank you.
I have a moment also to add. I think it's important to point out, if you look at the NOI for the property, it's like Jonathan pointed out, it's continuously going up year over year. If you look at the original assessment, we came in around 3.99. The 2025 information provided by the owners around 6.32. The appellant's asking for NOI of barely 6.1, not even at 6.1. We don't believe that's realistic compared to what the history is showing. Along with the support from our cap rate, as Jonathan said, I mean, the assessment should be confirmed based on that information provided.
Okay, thank you. Questions from board members? Mr. Pace.
This one's for Mr. Price. You're showing a drastic increase to the vacancy. What information do you have to support that income loss? Are you already seeing the increase in your vacancy?
So what do you mean by we're showing a drastic increase in vacancy?
So if you look at the operating year of 25, you're showing a vacancy rate of 2.81%. You're showing that your pro forma is at 3.7%. So what are you showing to indicate that we have an increase in vacancy?
So we're using for vacancy, we're using the 4%, which is stated in the Arlington County guidelines. For the apartment section, that renders that 4% renders a vacancy and collection loss of 260,000. And then looking at our the 2025 INE, our total vacancy and collection loss is 285,000. So although the percentages, with the actual vacancy at the property being, I believe, 2%, because there's just 4 vacant units, there is still, a percentage doesn't tell the whole story. There is still some vacancy and collection loss there.
Do you know what their
That's being
vacancy
captured.
is? Do you know what the vacancy is as of today?
As of today, no, I do not know what their vacancy is.
Okay, other questions? No? Okay, Mr. Bynes, if you take a minute then to wrap up.
Yes, thank you. When you compare the appellant's pro forma numbers compared with what's actually happening at the apartments, 2025 and even previously, we believe our assessment is more in line with what is actually happening at the property. There's no reason to believe that performance at the property will go down just based on the recent history. And we believe that we should be confirmed at $108,123,300. Thank you.
Okay, thank you. Mr. Price, if you take a minute to wrap up then, please.
Yes, so we do acknowledge that there has been an increase in the income year over year. There's about a 5% increase in income year over year, but there also is an increase in the expenses. I know I'm kind of beating this dead horse of the operating expenses are high, but it's the truth. And we believe that the county is not accounting for that. I do understand that that our NOIs are similar in many regards. For the calendar year 2025 versus the Arlington counties. But then in their test, they drastically, not drastically, but they increase the income, and then they do give some more credit for the expenses. So in our analysis, we just believe that there's more to just looking at calendar year 2025. When you look at the 3-year performance of the property, the NOI is just under 6 million. So with all that being considered, we believe an adjustment is warranted for this property.
Okay, thank you. Okay, it's just among the board. you know, I struggle with this a little bit. I see where, yes, income is a little off, expenses are a little off, vacancy. But the bottom line is when you look at the NOI, I would disagree with what the appellant just said, that the average is as low as what he's saying, because he's throwing in 2023. But it's certainly not going down by 300,000. So I think the number, regardless of how you get to it, the number that he's using for a combined NOI of just over 6 million is just too low. I think the county is fine on this, on the original assessment. I do agree that in the test that it seemed to increase, although they increased the expenses, they increased the income quite a bit. I think the original assessment, I'm fine with it. Where are other folks? Mr. Yates?
I would agree with you in that. I'm looking at the appellant's income and their, excuse me, let me slide back over my screen. Yeah, their EGI coming down 255,000, but then using the same expenses as 2025. I could see an adjustment to expenses somewhat, but I think their income's off. I think at the end of the day, for what the county knew at the time, I think they came up with a good projection of what it'll be.
Okay, Mr. Pace, I think you had your hand up.
Yeah, initially, when I was looking at the increase, it was at 9.86%. And I thought the county's income numbers were more in line where this property should be. And so I was looking at the expenses, and initially I raised it to 25% versus the 24%. And I got my number was around 105 million. Which is only an 8.72%. But after hearing from both sides, I'm actually with the county on this one. I don't think there's an adjustment needed.
Okay, Mr. Mendez or Mr. Penaranda?
Yeah, I'm okay with the assessment. I was running some tests, and all things considered, I'm okay with it.
Okay, Mr. Penaranda, anything different from you?
No, I think we're on the same track. I did a couple tests also increasing the expenses, but overall, yeah, I think the numbers on the top more than compensate for that. I even went to 26% more than Mr. Pace, but I'm okay with the assessment the way it is.
Can I add one more thing real quick?
Mhm.
We have to remember this property is only built into 12, so it's a younger property than the other ones. So the expense side should be lower. They shouldn't be as high. So that's why I feel like the county did a better job with capturing what the expenses should be.
Okay. All right, then I will make a motion to confirm the county at 108,123,300. Do I have a second? Second by Mr. Pace. All in favor? Aye. Opposed? Okay, there are no opposition. The county is confirmed at the 108,123,300. Thank you both.
All right,
Thank you for your time this morning.
Okay, that completes the agenda. The only other thing for anybody who's just reading cases for tomorrow, the third case on the agenda, BOE case number 319, is going to withdraw. That's the property on North Glebe Road. So just to save you if you haven't read the case already, but you don't read it for tomorrow. Okay, does anybody have anything else?
Can you state that again, please? I'm sorry, I missed it.
Sure, no problem. It's the third case on the agenda. It's the RPC 1405904A on North Glebe Road
Okay.
that we're going to vote to allow the withdrawal of that. Okay. All right, then we will stand adjourned here at 10:38. Reconvene tomorrow morning in person for the board members, June 24th at 9 a.m. Thanks, everybody.
Thank you.
Thank you.
Thanks.